I need to share something with you about financial markets, something that most people don't understand, something that threatens not just your financial security, but your very ability to make sense of the economic world around you. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day. You may know me as a hedge fund manager who generated returns of over 30% annually for 3 decades. Or perhaps you know me as a philanthropist who has given away over $32 billion. But what I really am is a philosopher who happens to understand financial markets. And what I understand, what I've built my career on understanding, is that markets are always wrong. Not sometimes, always. The only question is, by how much? Before we continue, I encourage you to subscribe to this channel. The ideas we discuss here challenge conventional wisdom and are based on decades of experience navigating market crises and understanding the forces that drive them. The belief in market rationality, the efficient market hypothesis, is perhaps the most dangerous misconception in modern finance. It contributed to the 2008 financial crisis, it fueled the dot-com bubble, and it's at work right now, creating distortions that will eventually unravel with devastating consequences. What I'm going to explain to you is reflexivity, a concept that will help you understand not just current market irrationality, but every financial crisis. Most economists believe that markets move toward equilibrium, that prices reflect fundamental reality. They're wrong. Markets don't just reflect reality, they help create it. The participants' perceptions influence the fundamentals, which in turn influence perceptions, creating a self-reinforcing feedback loop. And right now, this process is playing out across multiple markets simultaneously. By the end of this video, you'll understand the philosophical framework that has guided my investment decisions for over 60 years, why the rationality assumption is fundamentally flawed, and what you need to do to protect yourself in a world where markets are perpetually wrong. Let me start with a proposition that most economists reject. Markets are always wrong. They don't reflect reality, they help create it. Consider what we've witnessed in just the past few decades. The NASDAQ rose from 1,000 in 1995 to over 5,000 in 2000 during the dot-com bubble, then lost $5 trillion in market value when it crashed. U.S. housing prices rose 124% from 1997 to 2006. Fueled by the belief that they could only go up, before triggering the 2008 global financial crisis. Bitcoin surged from $17 per share in January 2021 to $69,000 by November 2021, a 1,700% increase in less than a year, before crashing back below $20,000 during the GameStop saga of 2021. Retail investors on Reddit drove a failing company's stock from $17 to $483 in weeks, causing 17 trading halts and billions in losses for hedge funds. Conventional theory says these are aberrations, temporary deviations from rational pricing that markets eventually correct. But what I see is reflexivity at its most powerful. Let me explain. There are 2 functions in financial markets. The cognitive function, where participants try to understand reality, and the participating function, where their actions change that reality. When these interact, they create feedback loops that take markets very far from equilibrium. The prevailing wisdom is that markets are always right. I take the opposite position. Markets are always wrong, they always miscalculate to varying degrees. The efficient market hypothesis posits that all available information is instantly reflected in prices. This assumes perfect knowledge that participants can understand reality objectively. But this is impossible. Imperfect understanding is the human condition. There is no shame in being wrong, only in failing to correct our mistakes. My conceptual framework is built on two propositions, fallibility and reflexivity. Let me address fallibility first. The participants in financial markets are human beings operating with imperfect understanding. Recent behavioral finance research confirms what I've known for decades. Even high-wealth investors exhibited significantly distorted expectations at the peak of the late 1990s market boom. They knew the market was overvalued but believed it wouldn't correct quickly, a classic misconception that reflexivity explains. Studies analyzing investor behavior from 2014 to 2024 across major indices like the S&P 500, FTSE 100, and Nifty 50 reveal that cognitive biases, overconfidence, loss aversion, herding behavior significantly affect market outcomes. These aren't random errors, they're systematic patterns that create predictable distortions. Consider the VIX, the fear gauge that measures expected volatility. When the VIX is low, below 20, it indicates market complacency. When it spikes above 30 or 40, it signals extreme fear. Since its inception in 1993, 61% of the highest fear days occurred during the 2008 financial crisis. The VIX doesn't predict direction, it measures the magnitude of expected swings. But here's what's crucial. It measures participants' perceptions of uncertainty, not actual uncertainty. Those perceptions then feed back into trading behavior, creating the very volatility they anticipate. This is not a free market correcting itself toward equilibrium. This is a self-reinforcing boom that will inevitably become a self-reinforcing bust. Understanding fallibility is crucial. The participants don't see reality as it is, they see it through biases, emotions, and misconceptions. And these misconceptions aren't passive. They actively shape the reality we're trying to understand. Every bubble has two components, an underlying trend that prevails in reality, and a misconception relating to that trend. When positive feedback develops between them, a boom-bust process begins. The underlying trend, technological innovation and real change. There is always a real change at the core of major bubbles. In the dot-com era, the internet genuinely was transforming how business operated. The misconception was that any company with a double quotes .com in its name deserved a multi-million-dollar valuation even with zero revenue. In the housing bubble, home ownership genuinely could build wealth over time. The misconception was that housing prices could never fall, that mortgages to people with no income and no assets were sound lending because the collateral would always appreciate. In the cryptocurrency boom of 2021, blockchain technology genuinely offers innovative possibilities. The misconception was that every digital token would continue rising indefinitely, that fundamentals didn't matter because this time is different. But this trend has given rise to a misconception that the trend itself is infinitely sustainable, that normal valuation metrics no longer apply, and this misconception is driving behavior that reinforces the trend, creating a self-fulfilling prophecy until it becomes self-defeating. I've seen this before. In 1992, there was a real problem with Britain's position in the exchange rate mechanism. The misconception was that the Bank of England could defend the pound indefinitely against market forces. My funds made over $1 billion in a single day because we understood the reflexive process. We recognized the point at which the positive feedback loop would reverse. Market fundamentalism, the ideology that enables bubbles. There's an ideology at work, market fundamentalism. The belief that markets are always right, always move toward equilibrium, that government intervention is always wrong. This ideology is itself a misconception that prevents necessary regulatory actions to stop bubbles from growing too large. Market strategist Jeremy Grantham explicitly stated that the efficient market hypothesis was responsible for the 2008 financial crisis, claiming that belief in the hypothesis caused financial leaders to have a chronic underestimation of the dangers of asset bubbles breaking. Former Federal Reserve Chairman Paul Volcker said it plainly. It should be clear that among the causes of the recent financial crisis was an unjustified faith in rational expectations, market efficiencies, and the techniques of modern finance. I'm not against markets. I've made my fortune in markets. But markets need guardrails. Without regulation informed by understanding of reflexivity, they will go to extremes. They always do. The 2008 crisis revealed the catastrophic consequences of assuming market efficiency. Investment practitioners miscalculated risks because they believed markets would self-correct. Regulators fell asleep at the switch because they believed prices reflected all available information. The collapse of Lehman Brothers, Bear Stearns, and dozens of other institutions proved the opposite. When you take massive risky positions financed with extraordinary leverage, you are bound to lose big one day, no matter how large and venerable you are. Who benefits? The profiteers of misconception. In every bubble, some profit from the misconception. During the dot-com bubble, investment banks made billions on IPOs of companies with no business model. During the housing bubble, mortgage originators, investment banks packaging toxic securities, and rating agencies rubber-stamping AAA ratings all profited while millions of ordinary Americans lost their homes. During GameStop, we witnessed something unprecedented. Retail investors coordinated through social media to create reflexive feedback loops that challenged institutional short sellers. Over 25% of all market deals in mid-2020 were made by retail investors, a massive shift from institutional dominance. This demonstrated that herding behavior can emerge from below, not just from Wall Street institutions. The threat to open society. What concerns me most is not just economic damage, but the threat to open society itself. When markets collapse due to misconceptions enabled by false ideology, the economic devastation creates conditions for authoritarian regimes. I survived Nazi occupation. I've seen how economic crises destroy democratic institutions. The 2008 crisis led to widespread job losses, foreclosures, and erosion of trust in institutions. This created fertile ground for populism and democratic backsliding across the Western world. The political consequences of financial crises are often more severe than the economic ones. This is about more than money. It's about the survival of open society and democratic institutions. To understand where we are in the boom-bust cycle of market irrationality, we need the macro context. Central banks operate under their own misconception. They believe they can manage the economy through interest rates and money supply alone. They can influence trends, but cannot prevent reflexive processes from taking hold. In the reflexive process, we typically see stages. Stage 1. The trend and underlying change begins. Technological innovation, credit expansion, regulatory change. Stage 2. The misconception. Participants misinterpret the sustainability of the trend. Stage 3. The boom. Misconception and trend reinforce each other through positive feedback. Stage 4. The test. Reality pushes back, creating a temporary setback. Stage 5. The climax. If the trend survives the test, conviction strengthens and prices reach extremes. Stage 6. The reversal. The trend becomes unsustainable and the positive feedback becomes negative. The critical insight is this: the reversal is not caused by external shocks. It's endogenous to the process itself. The misconception eventually collides with reality. Based on current market conditions, we see dangerous signs across multiple markets simultaneously. Behavioral finance research from 2024 reveals that cognitive biases continue to drive market anomalies. Despite decades of academic research documenting these patterns, they persist. Why? Because, as Kahneman and Tversky demonstrated, these biases are systematic features of human cognition, not random errors. The VIX currently sits at relatively moderate levels below its historical average of 19.39, suggesting market complacency. Low volatility expectations often precede major corrections because they indicate participants have become too confident. Studies of market sentiment using the Fear and Greed Index show wild swings in recent years. During the COVID-19 crash of March 2020, the index hit extreme fear. By year-end 2020, it reached 90 extreme greed as stimulus flooded markets. These violent swings indicate that markets are driven by emotion and narrative, not rational assessment of fundamentals. Let me show you what this means for the average investor. Consider someone who invested $10,000 in Bitcoin at $60,000 in April 2021. By June 2022, when Bitcoin hit $19,000, that investment was worth roughly $3,167, a 68% loss. If they panicked and sold, they locked in devastating losses. If they held through the cycle, they would have recovered, but only because Bitcoin's reflexive pattern includes both violent booms and busts. The NASDAQ lost $5 trillion during the dot-com crash. Millions of individual investors saw their retirement savings evaporate. The 2008 housing crash wiped out $11 trillion in household wealth in the United States alone. This isn't just domestic. Market irrationality creates distortions across the global financial system. In 1997, what started as a currency crisis in Thailand spread throughout Asia, the Asian contagion. In 2008, subprime mortgages in the United States nearly brought down global finance. The interconnectedness we see today creates conditions for similar contagion when markets operate under the misconception of rationality and efficiency. Systemic risks go unrecognized until it's too late. Let me tell you what you need to do both to protect your finances and help preserve open society. First, embrace fallibility. Recognize your understanding of markets is imperfect. Mine is too. This recognition is wisdom, not weakness. Be flexible. Adjust as new information emerges. As I say, I'm not better than the next trader, just quicker at admitting mistakes and moving on. Never assume you have perfect information or perfect understanding. The moment you believe you've figured it all out is precisely when you're most vulnerable. Second, understand reflexivity in your decisions. Your actions are part of the system. Ask yourself, am I following a trend because it makes fundamental sense, or because others are following it? How might my misconceptions be shaping my decisions? What feedback loops am I participating in? If everyone believes the same thing I believe, what happens when that consensus breaks? When I see a bubble forming, I rush in to buy, adding fuel to the fire. That is not irrational, it's understanding that positive feedback loops can persist longer than rational analysis suggests. But I watch carefully for the inflection point when the reflexive process begins reversing. Third, protect yourself strategically based on behavioral finance principles. If heavily concentrated in any single asset class based on recent performance, diversify immediately across uncorrelated assets, set stop-loss levels and stick to them. Don't let loss aversion keep you in losing positions. Reduce leverage aggressively if moderately positioned. Rebalance toward assets trading below historical valuation metrics. Maintain cash reserves for opportunities when bubbles burst. Use volatility spikes, high VIX to add positions, not exit in panic if insulated but concerned. Study historical bubble patterns to identify early warning signs. Monitor sentiment indicators, VIX, fear and greed index, margin debt levels. Prepare psychologically for volatility. Emotional discipline is as important as financial analysis. Fourth, engage politically. This is a policy problem requiring political engagement. Support candidates and regulators who understand systemic risk and reflexivity. Oppose market fundamentalist policies that assume efficiency and self-correction. Advocate for transparency in financial markets. Support institutions that foster open society and democratic accountability. The survival of open society depends on citizens who understand that markets are not always right, who can think beyond immediate self-interest to recognize systemic risks. Fifth, think systemically. Don't just protect your personal interests. The feedback loops between markets and society affect everyone. Support policies that prevent excessive leverage and systemic risk concentration. Provide counter-cyclical regulation that restrains booms and cushions busts. Maintain democratic accountability over financial institutions. Foster genuine competition rather than monopolistic concentration. Invest in financial literacy so more citizens understand these dynamics. When markets collapse under the weight of their own misconceptions, the political and social consequences extend far beyond finance. Let me conclude with the two ideas that have guided my life: fallibility and reflexivity. We cannot know reality perfectly. Our understanding is always imperfect, distorted by cognitive biases and emotional limitations. In financial markets, this creates opportunities but also catastrophic risks. And our perceptions don't just reflect reality, they help create it. The feedback loop between thinking and reality drives boom-bust cycles. This is what makes markets fundamentally different from natural sciences. In physics, the theory of gravity doesn't affect how gravity operates. But in markets, our theories about how markets work actively shape how they actually behave. The belief in market rationality is not just wrong, it's dangerous. It leads to complacency when vigilance is needed. It prevents necessary intervention when bubbles form. It creates the very instability it claims doesn't exist. The efficient market hypothesis became a self-fulfilling prophecy in reverse. Believing markets were always right made them more wrong. But we have agency. We can recognize misconceptions. We can interrupt feedback loops before they reach extremes. We can demand regulation informed by reality, not ideology. This requires intellectual honesty, political courage, and systemic thinking. The conceptual framework of fallibility and reflexivity has helped me make billions. More importantly, it's helped me understand the forces shaping our world, forces that determine not just wealth, but the fate of democracy itself. Markets are always wrong. The question is never whether they're wrong, but by how much, in which direction, and when the inevitable reversal will occur. I hope this framework helps you navigate the irrationality inherent in all financial markets. More than that, I hope it helps you become the kind of citizen open society needs: someone who thinks critically, questions conventional wisdom, and recognizes that human fallibility requires humility, not hubris. The future is uncertain. Markets will continue to miscalculate. Bubbles will form and burst. But we can shape that future if we understand the reflexive process we are part of, if we reject the dangerous fiction of market rationality, and if we build institutions that account for human fallibility rather than denying it. Thank you for watching. Now go forth with open eyes.